Hello there. Welcome to Market Call. Our guest is Richard Orrell. He is portfolio manager at RN Croft Financial, and he's going to be taking your questions on exchange-traded funds. There are the coordinates. Call us toll-free, 1-855-326-6266, or email us marketcall@bnnbloomberg.ca. It's great to see you.
Good to see you too, Andrew.
Hard to know where to begin.
Yeah, there's a lot going on this year. So we came into 2026 looking at U.S. midterms. We always knew that was going to bring some volatility into the market. We had our eyes set on interest rate decreases in the most likely scenario by for sure the U.S. Federal Bank, maybe the Canadian Central Bank, but that's shifted immensely in the past couple of weeks, really, right? So we priced out. The market is pricing out right now those interest rate cuts and has pushed them out in the U.S. till 2027.
Nothing this year.
Nothing this year, yeah.
Because of the inflationary impact of higher oil?
Yes, essentially. So we were seeing a shift from them monitoring the inflation basket versus the labor market, and the labor market taking a lead of what they were kind of focusing on. Obviously, they have that dual mandate to balance those two factors. And now with oil prices climbing, we're seeing the shift onto inflation. And there is actually even some tail risk out there that there might be actually some hikes.
Let's have a look at the TSX, because, of course, it has been something of a winner, comparatively speaking, because of our oil and our gold, even though gold hasn't done that well since late February.
Yes, yeah, for sure. So, I mean, that's a nice little theme. We've been resilient here. We've got that natural hedge between both oil and gold in some ways. Gold was there early, tailed off, as you mentioned, in February, but now we've got energy really taking the lead and holding the indices up. We've still seen a modest pullback, obviously, in the composite index. But I think, as Canadians, we tend to hold more Canadian equities in our portfolios. We've been somewhat insulated from the impact.
I'm not seeing energy stocks generally hitting new highs today, despite the latest surge in oil. So Imperial Oil, actually, IMO, trading in record territory. But not XEG, for example, the energy ETF.
Well, and it's really right now, it's kind of going back and forth, right? You have the president last night in the U.S. addressing the nation, we're going to, one sentence, hey, it's going to be over, but we're going to hit them hard for 2 or 3 weeks.
Yes.
So very mixed messaging. Even as I was just before I left my house to come in here, there's a headline, Iran's working with Oman to open the strait potentially, and markets ripped and oil tanks. So it's day by day right here. What I would be looking for is the volatility index, so the VIX. That you look at is trading right now around 28.30. We want to see that get that back down below 20 before the markets kind of calm down.
I mean, there's talk that Trump might put U.S. Marines ashore on these crucial islands in the Gulf of Hormuz. It kind of reminds me of World War II. Of course, the Marines had to take islands against fanatical defenders, and it wasn't a pretty picture.
Yeah, well, I'm not an expert in historical events necessarily.
Me neither.
But I did read something about Karg Island, where I guess 90% of Iranian oil flows through that island, and what it would take for the U.S. to take that island. Very scary idea, right? But from an economic standpoint, I understand that Iran could defer and move some of that oil down the coastline about 25%. Still, it's a major impact, and I'm sure you've got other guests that are far more well-versed in oil than I am. But yeah, between the strikes and some of the capacity or infrastructure that's been taken out and this uncertainty, I don't see oil dropping substantially anytime soon.
That's interesting. The whole world economy, it turns out, pretty reliant on materials. The plastic people are suffering or worried now because crucial feedstock came from that part of the world. Sulfur for copper processing, you name it.
Yeah, exactly. You're right. I mean, I even heard helium is a big one, and it goes actually into the semiconductors. So you've got all these impacts downstream from this higher price. Fertilizer stocks have been doing well because I guess there's less capacity for some of their inputs. It's a really interesting time to watch, and I think in many ways this is where ETFs kind of show some of their value. You start to take up some of that volatility when you have ETFs, or you're not picking on single stocks and having your portfolio swing in different directions. So ETFs are still liquid. You can sell them any day you want, anytime you want. You might not like the price, but you can always sell them.
Yeah. They're not like some of these real estate funds that have halted redemptions.
Also true, yes.
Liquidity has a great beauty in times like this.
Absolutely.
Okay, Richard Orrell is taking your questions on ETFs, 1-855-326-6266, or send an email to marketcall@bnnbloomberg.ca. Let's kick off with an email. Joe has got in touch, wants to know what you think of the CDZ ETF. Now, this one is the iShares TSX Canadian Dividend Aristocrats.
Correct. Yeah. Yeah. So this ETF, and he's been actually around for a long time. It was part of the Claymore, like back in 2006.
Right. That's a while ago, yeah.
Claymore got bought out by iShares in, I think, 2012. This ETF, as the name suggests, deals with dividend aristocrats. So what's an aristocrat in this case? It's a company that has, increased their dividends for the last 5 years at least. Okay, so if you don't meet that criteria, you're not in, and you got to be in Canada. So this ETF is fine. I mean, people have done very, very well. If I had to pick one, if I'm being really, really picky, the MER is about 66 basis points. Okay, and I think since 2006, when this first came out, there's been, many other ETFs that have fallen into the space. So Canadian dividend, high dividend paying stocks. So and the MERs and the MERs have come down substantially. Mm-hmm. Okay, so I've actually got one of my top picks a little bit later on in the show. Mm-hmm. But yeah, nothing wrong with this. I would add, if you still like this area, you could use another one to not commingle your cost base. So if you still like high dividend paying Canadian stocks, but you don't want to buy more of that because you've got a nice capital gain and you don't want to worry down the road, you don't want to commingle the asset cost bases, you could use an alternative, which is like an XDIV or an XEI.
Well, that's interesting for the tax calculation. Yeah, you want to give yourself flexibility. On selling. Yeah, that's interesting. We have a caller from Montreal. Alan, go ahead, please.
Yeah. Thank you very much for taking my call. I'd like to ask your opinion of a Canadian general ETF covering the Canadian market. I'm looking at XIC. That's the iShares Core S&P TSX Capped Composite Index ETF, XIC.
Thank you.
Thank you very much.
Thanks, Alan.
Yeah, so Alan, thank you for the call. This would do it, Andy. I mean, this is the Canadian market across all of our sectors. As we mentioned in the opening, and as I'll get to, we've been a global standout. We have had a pullback there, but I think if you don't, you got to look at your whole portfolio and what you have in your whole portfolio. But if you're underexposed to Canada, XIC would be reasonable. I like that it's capped, so you get a bit more, you get a bit broader spectrum there, as opposed to sometimes the financials and the energy sneak up into the 6 or 7 or 8%, right?
Right. Yeah. I'm looking at the big holdings, Royal Bank of Canada, almost 7%. TD, that's interesting, almost 5%. And then Shopify, just north of 4%. Yeah. Some oils, but oil's actually not that high in the big holdings. It's kind of interesting.
Interesting.
CNQ, it's in the top few, but it's only 3%.
Now, these indices potentially will rebalance and correct that at some point in the year.
Sure.
And I don't know on this one if it's semi-annual or annual. But you could see some shifting there.
Right, and you're picking up a so-called trailing yield of 2.1%, which is not that bad. Yeah. Joe is calling from Montreal. Great to hear from another Montrealer. Go ahead, please.
Thank you, Andy. I want to ask your guest about HHIS, the Harvest Diversified High Income Shares. I know it's been down over the past year. I like the tech portion of it. And what he thinks for this for a retiree's income and also his TFSA account. I appreciated his comments. Thank you.
Right. So this, in theory, has a very big yield. Looking at the website, they're saying current yield almost 32%.
Yeah, so that's way too high. That's not going to be sustainable. But I believe these products are a combination of some of the other underlying ETFs.
The single stock ones. Sorry.
Exactly. So single stock ETFs, and they put them together, and then they developed this product to get a much broader approach or a bigger basket. So yeah, the yield, I wouldn't trust the yield. That gets complicated depending on your tax factors, return on capital, capital gains. These guys are obviously writing option strategies on these too.
They're writing calls, and they're using what they call modest leverage.
Okay, so for me, as soon as I hear modest leverage, I'm out. Okay, so I don't employ anything. I don't mind covered calls. I got nothing wrong with that strategy, but I don't want to have the leverage. So for me, this is a no-go. If they have a non-leveraged version, then I would be a bit more interested. But again, the yield of 32% is not sustainable.
Yeah, I'm just looking. The big holdings are tech companies, as the caller indicated. Giant names like Broadcom, et cetera, seem to dominate the portfolio.
Yeah. I mean, when you're doing option ranking strategies, some people gravitate towards the higher names that are more volatile. There's more premium in the options. I find sometimes the more boring names are actually where you can, you hold the stock, you write the call, you collect the premium, and you get the dividends along the way. So for me,
not for you.
Not for me.
Okay. Dan is in Wasaga Beach, Ontario. Go ahead, please.
Hey guys, thanks a lot for taking my call.
Pleasure.
Curious on your guys' opinion about XEQT.TO, and just maybe you could have a look at it. Thank you very much, guys.
So that one is iShares Core Equity ETF.
Yeah. So this one is a very broad global equity base. It's 100% equity. So if you're using that, if you're very young and you're okay, you can, and with the volatility, you can use this. I actually use the Vanguard version more because I think it has a higher concentration to the U.S. But it's a good solution if you just want to kind of set it and forget it, and you don't want to break it down into different components. Good for young investors, but again, this is in your equity sleeve. So for older investors, this has got to be in your equity and not being counted on for any necessarily any income source.
The size of some of these ETFs, this one is about $15 billion.
Yeah, they've really grown. They've really collected a lot of assets.
Yeah.
This is where ETFs have just kind of eaten the lunch of mutual funds. They've just gathered so many assets in things like this because they do make it available to the kind of average investor. But again, you got to know your asset allocation.
There's just looking here. The U.S. is about 43%. Canada's about 25%. And then Japan 6%.
Yeah.
And the biggest single holding is the TSX Composite ETF at almost at 26%. Dan, thanks for the question. So maybe for a young person who it's just hold it, don't even look at it, and it's long-term stock exposure.
Yeah, if you've got someone able to put away a couple $100s a month, and they've got some platform where they can, it doesn't cost them much to trade, it's a good solution.
Yeah. I mean, it's going to grow broadly in line with the world's economy, I suppose, in the long term. Yeah.
The U.S. is still the main economic engine. I mean, we don't obviously love what's going on down there, but it's still the driver of growth. I would say historically, 25% Canada is probably too high. But again, if you're trying to keep it simple, not complicate matters, the idea of putting money away constantly is the real habit that is going to help you, not necessarily what you put it in.
We're going to be back with Richard Orrell of RN Croft Financial Group taking your questions on ETFs. And there's that number, 1-855-326-6266. Okay, we have Ron calling from Cochrane, Ontario. Fire ahead, Ron, please.
Well, it's Cochrane, Alberta, and it's snowing like crazy over here.
What? Okay, condolences on that one. Thanks, Ron.
Good afternoon. Thank you for taking my call. I got an 8% position in my portfolio on a couple of stocks on the AI pick and shovel. I'm looking for an ETF that would be more of what I would call an AI general type stocks, 3 or 4 or 5, 6 or 7 stocks into that ETF to spread the risk, because with new technology, there's always winners and losers, and I don't want to be stuck with a loser at this point in time. Thank you for taking my call. I'll listen to your comments. Thank you very much.
Thanks.
Okay, Ron. Well, I had something for you until you constrained me to 6 or 7 stocks. So ETFs in general, I should say, there's a single stock we just talked about, but in general, they hold baskets of stocks that are much broader, right? So we're getting in towards 60, 70, 80 stocks. The one that we've looked at is AIGO. Okay, it's called AIGO. It holds the picks and shovels, but also some of the software, the other components, the data centers, energy, stuff like that.
What's the symbol?
AIGO.
AIGO.
Yeah,
okay.
it's by Global. I believe it's by Global X.
Okay.
It trades both in the U.S. and Canada.
Okay.
I would obviously recommend using the Canadian version. Same holdings are very similar.
Yeah.
But that is going to broaden your exposure. So if you're gonna sell or kind of isolate a couple, if you have some winners or losers and you just want to maintain your exposure, it's a great idea. Sell some, Nvidia, Broadcom, et cetera, and move into an ETF like this.
Yeah, and so this one, as you say, it's Global X AI and Technology Index ETF, and not huge. It's only about 17 million right now, but I'm assuming the usual suspects are in the top holdings. Certainly, the United States is 65%.
It's a relatively new ETF to Canada. It's been around a little bit longer in the U.S. But it's a good mix. You're gonna get Samsung and SK Hynix over in South Korea. So you're also broadening out not only from the U.S. Yeah, you've definitely broadening out from the U.S., which is important.
Yeah. As you say, Netflix. I don't know how they're an AI play, but Taiwan Semi, Apple, etc.
Yeah.
Thanks, Ron. And we've got Ash calling from Oakville, Ontario. Go ahead, please.
Hi, thanks for taking the call.
Pleasure.
What's the guest quick take on PIMCO Global Income Fund? Thank you.
And do you know the ticker on that one by any chance?
PGI -UN. PGI.UN.
Thank you very much. Okay.
Okay, so Andrew, the PIMCO Global Opportunity Fund, I'm not as familiar with.
Okay.
But I do use the PIMCO Monthly Income Fund in my client portfolios. Now, the PIMCO Monthly Income Fund has a high expense ratio. And some people say, well, you're just having a mutual fund. Well, my rebuttal to that is that PIMCO has access to parts of the fixed income market that I would never have access to. They have opportunity. With that, what I'd be worried about on this global opportunities is what am I getting into? And am I getting into any private credit type situation? We talked about real estate and the ring fencing and stuff and things like that. Is that in here? So, without doing a deeper dive on this one, I can't comment completely. But that's what I'd be looking for. I'd make sure I'm taking a fine-tooth comb and I'm going through all the holdings to make sure that I know what I own in here.
Right. Yeah, because we have seen some selling in the private credit market. Yeah.
Yeah, and Andrew, just as a comment in general, by the time usually these things get to the retail investor, private credit, the party is usually over. All right, it's done. We want to avoid it. We don't want to be getting in at that stage. It's just, this is a cycle that repeats itself over and over again.
Yeah, I don't have high yield credit. It's something like 19%, I believe, of the portfolio. And anyway, but I don't have a full breakdown of what's in there. But that's interesting. Yeah, look at these fixed income funds. What's exactly in there?
Yep.
Charlie in Montreal, go ahead, please.
Hi, thank you for taking my call.
Pleasure.
I'm new investor, so the consensus on Bloomberg seems to be to just buy the indexes if you cannot properly evaluate the stocks. So I own a VCN for the TSX and VFV for the S&P. I would like to know when is it a good time to add to both, and what proportion do you think I should own between the S&P and TSX in my portfolio?
Sorry, Charlie. Sorry to interrupt. What was the ticker symbol you gave us there?
VCN, Victor, Carol, Norman.
Okay. And right, so that one is Vanguard Canada All Cap Index ETF.
Right.
VCN,
Yeah, so these questions are very difficult. I have no, context I can't get in 30 seconds, right? So
yes.
I don't know the situation completely, but I can answer Historically, I wouldn't have more than 10 to 15% Canada in my portfolios, and that's going to be extremely low. But we just haven't been the economic engine that the rest of the world can be, and that's just a function of GDP and some of the past administrations we've had in Canada, and it's just not something that I would be wanting to go more weight than that. Now, we have an opportunity here, and I do have some picks, but I just don't think that going forward, we're going to see the type of growth. We've always been kind of a low growth, low volatility, grinded out type of country.
Yeah, this is very similar to a generic Canadian ETF, index ETF. Royal Bank TD are the biggest two holdings, and Shopify, then Agnico Eagle.
The chart would be exactly the same as the XIC, essentially, right? They're just battling it out for market share.
Right, yeah, and it uses a nominally different index, I guess.
Yeah.
Okay, we're going to have a look at Richard's past picks next. Okay, well, let's get to it. Richard was on our show March 10th of this year, so, wow, it's a pretty short period.
No, this should be last year.
Oh, last year, I'm sorry. Yeah, I'm living in the past or the future. Yeah, exactly. Sorry, March 10th of 2025. Your first idea was the Invesco S&P 500 Equal Weight Income Advantage, and that's EQLI. And so total return of 8% off this one.
Yeah, so it's an equal weight S&P 500 with a covered call overlay. And I've been running this in my portfolios, actually a similar fund called ticker is JEPI, JEPI. It's the JP Morgan version. And I just want to have a similar pick. So what I like about this is it's fairly benign. It generates some income from the covered calls. And the outlook was for the market to kind of be a little bit bumpy. And in this environment, it helps dampen the volatility of your overall portfolio. So it's not a huge weight, but it's a tactical sleeve. And then if things get look a little bit better and the market starts to calm down, I can sell this and I can replace it with a full equity where I think the opportunity for growth is much higher.
Your next one was ZUQ, BMO MSCI USA High Quality Index.
Yep. So high quality. These are some of these factor ETFs. They screen for, good return on equity, low leverage, these types of factors. You get out of some of the main tech, although they do have, they're in there. So like Broadcom, Eli Lilly, big names that are in there. And over time, long periods, 5-10 year periods, this tends to outperform the overall markets. So I throw it in and I watch it.
Okay. Of course, they say high quality, but every stock would like to have you believe it's high quality.
Fair enough. But, even the indices, you start to get into, and the other thing with the ZUQ is it does go into the mid-cap space a little bit as well. So if you start to deal in the Russell, you start to get into a lot of companies that don't actually make any money.
That's right. Yeah.
Right?
Yeah.
So by weeding those ones out, you're getting, you're moving essentially the quality of the companies up. And like I said, over 5, 10 year, 15 year periods, it tends to outperform. Over the short period, it may not, but over the long period, it does. And then they reconstitute the indices, right? So they kind of have these filters and they filter it down and you get these.
And they look, I guess, for things like consistent earnings and low debt.
Yeah.
Okay. Then your last one, pretty like a money market fund, Vanguard VVSG Ultra Short Government Bond Index.
Yeah, so it was just a place to park cash. I'm actually going back to similar in this top picks. Again, it's just, that was March 10th, and that was before Liberation Day happened last year, right? So I was looking for somewhere to kind of keep something, safe. And then, so this is 0 to 12-month T-bills. All the theory and this is the safest there is, right? There's nothing safer than this. So far, knock on wood. But so it's just a place to park cash if you're in between trades. And if you're kind of wondering if you're taking some profits, you need somewhere to park it, and you don't want to deploy right away, this is a place to put it.
All right. I mean, how would it differ from a money market fund? Pretty similar, I think.
Pretty similar.
Yeah.
We get a lot of clients asking about GICs.
Yeah.
The problem with GICs is your money's locked up. So I don't know when the opportunity could be. It could be now, anytime between now and the next year. But if your money's in a GIC, you can't move it. But at least in the VVSG, you've got access to it if you want to move it or if you need it for any expenses.
We're going to be back with Richard Orrell of RN Croft Financial Group, taking your questions on ETFs, 1-855-326-6266, or email us, marketcall@bnnbloomberg.ca. Okay, we were discussing the intricacies of ETFs there in the break. Let's go to New Westminster, BC. Dave is on the line. Go ahead, Dave, please.
Thank you very much. I'm looking at the price of oil going up and down and up and down. And today, the WTI oil for May is up 11.5%. I don't know how to get into that, but I'm wondering if you have an ETF that you could recommend for oil with these times.
So our preferred oil, one that we've had on our platform and we use for clients when they ask for this, is the ENCC. Okay, so it's the ticker again is ENCC.
ENCC.
Yeah.
Okay.
It does have a covered call component, so that can be a little bit difficult with the volatility here. If you don't want the covered call, then I would probably just go with the XEG, which is the Canadian basket. And I believe the Canadian basket has quite a few advantages. Obviously, we're isolated from any of this conflict, right? Our infrastructure is good. It's been developed already, and we've got pipelines to get it out to some places, right? Not as many places as we want, but to some places. So if you're looking for straight energy, I would go with the XEG. If you're looking to more of an income and can approach, then I would go with the ENCC.
Right. Okay.
Yeah, but it's had a fairly large rise there, Andrew. So again, I think oil, again, maybe Trump solves this tomorrow, but in my opinion, oil is not coming back down to $60 a barrel anytime soon.
Okay. Let's head to Kelowna, BC. Go ahead, Dave.
Hi, Andy. Welcome back.
Thanks very much. It's just for today, but thank you very much. It's great fun doing the show again. Thanks.
I got a question for both of you. Andy, did Michael Cockfield retire? I haven't seen him on for a long time. Do you know that or not?
Michael who? Oh, yeah.
Cockfield?
I'm not sure about that. I can look into it, but I'm not sure. I haven't seen him for a while, yeah.
Richard, going back to these ETFs like Harvest and Hamilton, and there's quite a few of them, 4 or 5 of them, they start out with a high dividend on their stocks. And then, 10, 12, 14%. And then all of a sudden, 6 months later, they start cutting them back down again. Why do they start so high? Why don't they start like 8% maybe or 9%? Is that one way to get us into the markets, those high dividends?
Okay, I mean, I can't verify that. I'm looking here at the Hamilton Utilities Yield Maximizer. Was launched in the summer of 2023. It looks like its dividend has been pretty constant at around 17 cents. It's come down a little bit now to just under 16 cents. So I can't comment on that directly.
Yeah, I guess I agree with the caller. They advertise, they start out with a unit price and they say, okay, we're going to have a basket of utilities, and over time they usually make X. And then we're going to write some covered calls and they pay a dividend. They say, okay, we're going to estimate that's our distribution, we'll call it, okay? But then real life happens, markets go down or they may not cooperate the way you want, and they still want to pay that distribution. So where does it come from? Give you your own capital back. It's a return of capital. So they maintain the distribution. The net asset value goes down, or the NAV goes down, and now you've got to make it up somewhere, right? So eventually they end up cutting. So it's just a timing of when they come to market. I always say you get to 8, 9, 10 double-digit yield, you have to look at it. You have to make sure you know how they're generating that yield and be very, very comfortable holding that sector or that basket of stocks.
I mean, I'm just looking at this Hamilton Utilities one, not to pick on Hamilton, but it just that it came up. So my Bloomberg screen is showing a 12-month yield of 14%, which is really high.
Yes.
But then the question is, I mean, there's no free lunch. And so according to my Bloomberg screen, this Hamilton Utilities ETF, which is more than $1 billion, it launched in the summer of 2023. And according to my screen, again, the total return is 24%. Whereas if you just bought the straightforward BMO Utilities Equal Weight Index ETF, you would have had a return of 46%, almost twice as big.
Yeah.
And the actual price of the ETF, according to Bloomberg, has dropped 15% over the period.
Yeah, you're right, Andrew. You got to look at total return. That's what really matters. There's some tax implications in there. But I worry people get lured in with the high yield.
Yeah.
And then, they get there and people have a hard time parting with things when they're down in their portfolios.
Yeah.
I see it a lot. I mean, and I've lived it as when I was younger, you thought your stock was going to the moon. Well, guess what? It became a zero, right? It happens. With ETFs, it takes a bit longer. But again, people have a hard time selling and admitting they're wrong.
Sure.
But in this industry, you have to accept that you're wrong quite a bit of the time.
Well, we should have Bob Wessel in. He's the executive chairman and co-founder. Maybe to discuss that.
Yeah, for sure.
Because he's always very articulate on his strategy. Yeah. Just to give his side. Ghulam in Toronto, go ahead, please.
Hi, good afternoon. My question is on ZWK and ZWE. I've already put some money into the utilities and the Canadian banks, but I thought I might have some exposure to U.S. banks and the European entities. So is this a good buy? Is it a good time to buy for the yield? I know it's a covered call option, but for the yield and any growth in there. Thank you.
So I heard ZWK there.
Which I believe is the Canadian banks or U.S. banks?
Yeah, covered call U.S. banks.
Covered call U.S. banks?
Yeah.
And ZWE. So is ZWE the European banks?
Just give me one sec, and I would not be surprised. It's Europe high dividend covered call.
Europe high dividend covered call?
Yeah.
And was it a choice or just both?
I was so busy trying to make sure I had the right.
Okay.
Do both quickly, if you would. Yeah.
Okay.
Yeah.
So ZWK, we've had in client portfolios in the past. Don't mind it here. I think the U.S. banks, deregulation has kind of taken a back burner. I think it's still out there. Assuming the private credit doesn't become a bigger issue, which I've been asking every time I meet with anybody in the industry, what's your take on private credit? And so far, people say it's not as big as people might think.
The problem, you mean?
The problem.
Yeah.
Like, I guess I'm trying to compare it to, say, a housing crisis or something like that. Like, is it that much of a problem?
Yeah.
No. So I think that the ZWK could have some upside. You have the covered call component to insulate you a little bit. But BMO has been doing the covered calls for a long time, and they get their yields kind of right. So I'm okay with that one. The ZWE, I do like Europe. The budgets are increasing there, so I'd be okay with the ZWE as well.
Okay. Thanks for the question, Ghulam. We're going to take a break. Richard Orrell of RN Croft Financial taking your questions on ETFs. We have John calling from Toronto. Go ahead, John, please.
Yes. Hi, Andy. I can't believe you're number one. It's great to see you there.
Thank you. That's really nice of you, John. You made my day. Go ahead, please. Thanks.
Okay. Richard, I apologize for my question because it's a very naive question. I've never owned an ETF. So if I put a hypothetical $100,000 into ZWU in my TFSA as a senior, I only want to know what is the danger or downside. It's up $1 or down $1. The yield is solid. Could BMO just decide to close the ETF? Do I get my investment returned, or do they expect me to stay invested with them? What is the danger to my hypothetical $100,000? And do you like ZWU?
Those are good questions.
Yeah, I wouldn't call them naive at all.
No.
They're what you need to know. So the BMO covered call utilities ETF is going to hold a bunch of underlying utility stocks. And so, John, I think I've mentioned this, in prior shows, the likelihood of you losing everything is very, very small because all the companies would have to go to zero inside the ETF, right? So I think you've got Fortis, Enbridge, major companies in there. And other than that, it's going to swing just like the markets would. And utilities tend to have a bit more sensitivity to rates. Rates probably going nowhere in Canada, so we're not worried about that too much. It's going to give you a bit of a yield. I can't comment on the size of the investment. I wouldn't put all of, if the $100,000 you have, I wouldn't put it all in here. But I think it can be an income component of a larger portfolio.
Right. So this is the BMO Covered Call Utilities ETF.
Yeah.
And okay.
And there's there's going to be lots of power demand. I don't know if TransAlta and some of those companies are in there. It's hard to remember all of the holdings of all these ETFs. There's 1,800 ETFs out there.
Yes.
But,
yeah.
Some of those companies have projects in the U.S., so you're going to get benefit from them supplying power to the data centers. So I think there's a lot of tailwinds to the sector, and it's kind of rounded out the bottom there, and it looks to be a spot where you can again collect that dividend and not see your capital erode too quickly.
So I'm looking biggest holding Verizon Communications, and then the second biggest holding, it's only 5%, is BMO's Equal Weight Utilities ETF with no covered call overlay. Then Fortis, Hydro One, TC Energy. Just comparing the return on this one, it's given you a total return since its launch in 2021. Sorry, I forget when it was launched, but a five-year return of 41% total. Whereas according to Bloomberg, the utilities index has given you a return of 48%. So a little bit higher. I mean, there is a fee with the BMO one.
So fee's part of it for sure over 5 years.
Yeah.
As well as the covered call. I think if you look at utilities, a lot of that return has been within the past year, right? So we've seen a high return in the past year, but throughout the whole time, BMO's been dampening the volatility a little bit. So I look at a lot of risk-adjusted returns and not just total return. Because if you're always looking at total return, I'm always going to take the riskiest asset out there. But that's not the whole story.
No, of course. Yeah. Let's squeeze in a caller. Bruce in Simcoe, Ontario. Go ahead, please.
Thank you. My question is on ZID, which is Indian dividend. It was doing well until the war. Now it's down. Would it be a buy now?
Okay, BMO MSCI India selection.
Okay, so I would avoid, basically just on that chart. So I think last time I was on was the end of January there. I think we had a caller. I said, you could try to pick it up, but you got to have a tight stop. And right now, it's not, there could be no bottom in sight here, right? So I'm not trying to be, I just wouldn't touch it, right? It's just not something I would be interested in. Hopefully you took your lumps. And I would wait for it to show some signs of bottoming. Andrew, catching falling knives is a tough skill.
Yeah.
It's almost better to wait and then see if it can get some positive momentum going before you dip back in.
Right. Yeah. Presumably, yeah. And I mean, and India is vulnerable in terms of oil imports. They don't have much of their own. Yeah.
They don't have much of their own, and they've got a lot of people, right?
Yeah.
So there's they need it. So. Any type of disruption for them is going to be, have a greater impact than us. And actually, just to go back to the oil thing for a second, I was recently at a session and I asked about, 1973 and there was an oil crisis back then. What's different? And the difference is that the U.S. can actually pump a lot of oil now with fracking and other sources. They can actually get they've got a lot more supply to themselves than they had, 50 years ago, right? So. It changes, but yeah, India for me right now, absolute no touch.
Okay. Coming up, we'll have a look at Richard's new top picks. Join us Monday on Market Call. It's Stan Wong. He's portfolio manager at Scotia Wealth Management, and Stan will take your questions on North American large caps and ETFs. Let's get to Richard Orrell's latest top picks. First off, iShares S&P TSX Composite High Dividend Index, XEI.
Yeah, so it's as we got to earlier in the show with some of the callers, Just got a high dividend Canadian focus there. Chart looks great. Bottom left to top right. Like to see that. Maybe a mild pullback as well. So again, I've been underweight Canada a little bit, and so I'm looking to catch up because I do see it as a bit of a hedge against what's going on with high oil prices and gold. So again, for many investors out there, this might not be a pick for them because they got to look at their portfolio and they might already have that component. But for me, as a tactical add to my portfolios, this is what I'm looking at.
Okay. And you're wary of Canada, though, because of lackluster economic growth, broadly speaking?
Broadly speaking, I mean, historically, we haven't done very much. But, we could see if oil prices can sustain higher, then we'll see some opportunity. And, maybe we've got some projects. I hear the Toronto Center Island and pipelines are going and things like this, right? So you never know.
Okay, so that's a dividend play in Toronto. The next idea here is the Vanguard FTSE developed ex-North America high dividend yield. So this would be G7 countries outside North America with dividends.
Correct. I'm not trying to get you paid by the word
I know,
here.
yeah. They give these things such names.
Yeah. So again, last time I was on, I was looking at the Franklin Low Volatility International. And again, this one is kind of in a similar space. So again, it's moving away from, again, I still have a lot of weight of US, but what else is moving out there and what else can I get involved in to maybe give myself a broader approach? Because I've been doing some research on things like lost decades and what happens. And global markets or international and emerging markets tend to be an opportunity, and gold as well. And so I just want to make sure that I'm playing a bit of defense here by getting out of kind of that heavy concentration in the U.S. And this fund has done well, and dividends tend to be a pretty good factor.
And then another near cash idea here, Global X 3-month T-bill ETF.
Yeah, so if anyone's nervous or they're moving money or they're keeping it on the side, again, it just goes up, pays a dividend, and then it goes back down. And there's one other neat feature of this ETF. So if you're looking to exchange currency on any size of money, let's say you sold a property in the US, okay? You can buy this as the cbill.u in a US account. You can ask them to journal it over to your Canadian account. It'll show up as cbill, and you can sell it. And voila, you just have gone from US to Canadian, and you'll find that your exchange rate is much, much lower, or the spread is much, much lower than what you would expect with a bank.
Well, that's interesting.
Yes.
Yeah.
It's a neat little trick.
I've never heard of anything like that. Yeah, because the banks will charge you, naturally too.
Yeah, I mean, you're subject to a few days of price movement, right? Because it takes some time.
Yeah.
But usually, for most retail investors, you're looking at a spread of, 150 basis points. And with these ETFs, you're going to be dealing with no more than 10. So you're saving 1%, potentially 1.4% on a big chunk of money. It can be a value.
1.5 they'll take, the banks.
Yeah, each side, yeah.
Isn't that interesting? Yeah. In an era of almost instant communications, the banks with their quill pens charge us that. That's one of the promises of blockchain, I guess, with these middlemen, getting them out of the way.
Yeah, potentially. But it's an interesting, I've done it with a few clients, and it works fairly well. And they, were like, oh, Richard, I wish I knew about this earlier. So I thought I'd
Yeah. Because on $1 million, 1.5% is 15,000.
Yeah.
ETFs, just money flooding in. We're almost out of time, but just no stopping this industry.
No stopping. You're starting to see a lot of it, I believe, come out of mutual funds. ETFs are just proving to be a better way. Like I always say, with an ETF, I can sell it in 10 minutes. I might not like the price I get, but I can always sell it within 10 minutes. Whereas a mutual fund, you got to wait for the end of the day, and it's less transparent on cost and things like that. So, it's just been a really good industry for the investor.
Thanks very much.
Yeah, good to see you, Andrew.
Richard Orrell has been our guest today on Market Call. Thank you very much indeed for watching. Stan Wong is up on Monday. Have a great holiday weekend.